Happy Tuesday night.
All right. Good stuff. All right. Do you want to give a little background on the new investor series?
So this is just part of a new investor series that we wanted to do talking about short-term rentals. We know a lot of people in the community are really interested in short-term rentals because of tax benefits, increased cash flow. And so we wanted to kind of spend some time educating and, connect more with our semi-retired physicians and professionals groups too. We're oftentimes in Empire Builders, which is our membership site or our course, but we wanted to spend more time with the big group.
Yeah, and also I think as new investors, sometimes it can feel intimidating to be around very experienced investors. So we wanted to make sure that we kind of created a setting where, as a new investor, you can come in here and ask whatever question, right? And for us, especially, it doesn't matter what your stage is. If you're a beginner or you're experienced, there are no dumb questions. So feel free to ask.
Please don't apologize.
Yeah, exactly. Yeah, feel free to ask any questions. The way this works is, if you have a question, we ask that you put it in the Q&A. The chat box is great for just having a conversation amongst yourself. And also our team will be posting different resources for you. And we have a lot of free resources. And again, our goal here is to really just share our knowledge about short-term rentals. And today, we're going to focus on the tax benefits. If you were here before, we did a session on market choice. And also we did a session on how to make money with short-term rentals. And we talked about cash flow and something called forced depreciation. So I saw a couple of hands go up. I don't know if there's any questions associated with those, but if you do have a question, please put it in the Q&A. And the way we've been doing these sessions is we've been doing probably about 10 or 15 minutes of a presentation. So pretty brief presentation.
Probably more like 20.
Right. Maybe it goes about 20. And so we'll do a 20-minute presentation and then we'll go to the Q&A. And so as we're talking, just if any questions pop in your mind, just put it into the Q&A, and then we'll take them one at a time. And then we may even pull up a couple of you guys to do some more deeper kind of one-on-one conversations. All right, with that, let's kind of go to the presentation.
Yeah, and for those of you who missed the first two, the way you can see them is they were streamed into the Facebook group. Are we streaming, by the way? Yes. And then
should be streaming.
Then they were also kind of sent out in the newsletter as video.
Yep,
so
we are streaming.
You got last week's newsletter. That was the one before, the video before, and then the week before was the first one.
Okay. Okay, well, that's not what I wanted to share. All right, let me kind of figure this out here. All right, here it is. Now you got to see my email.
one of the many.
But that's okay. There was nothing bad in there. Let's see. Okay, share. Okay. Okay.
Okay, so again, if you have questions, just throw them in the Q&A and we'll get to them when we're done with this, and then chat with each other. Feel free.
Okay, today we're going to talk about how you can save big on taxes with vacation rentals. If any of you are here and going, wait, there's a tax benefit? And I just wanted a vacation rental, a cool place that I can stay, or I wanted to make really good cash flow with my vacation rental. If this is you, then great, we're going to dive into it. Okay, so what we're going to cover is, if I buy a vacation rental, is the tax benefit really that good? And we're going to cover it from the perspective of a passive investor, because you can get great tax benefits as a passive investor. We're also going to talk about it from the perspective of an active investor as well. And we'll explain the difference. The next one is, don't I have to show a loss on my vacation rental in order to save on taxes? This is a common misconception. You don't actually have to lose money on your vacation rental. You can actually make money on your vacation rental and at the same time save on taxes. And then another common question is, what exactly can I write off? We'll cover those. And then what are the requirements for accessing the short-term rental tax benefit? So we'll cover that as well. All right, so let's first cover, when you're a passive investor, what are the tax benefits? And so passive means that you don't, you have a property manager, you don't spend a lot of time on it, you just buy the property, and maybe it's already furnished and you just hand it to a property manager and they take care of all the day-to-day stuff.
Yeah, I want to really clarify, this is not you're a passive investor in a syndication. This is you own the property. You're a direct owner, but you're just not materially participating, doing day-to-day operations. You actually have a property manager or another person kind of helping you out.
Right. So if you're a passive investor, you don't get access to the active benefits, which we'll talk about next, but still the benefits are really great. So first of all, if you make cash flow from your property, which you should, yeah, generally these taxes are going to be sheltered, or a big chunk of it is going to be sheltered. So you're going to significantly lower your tax rate. Let's just for argument's sake, let's just say that you do shelter all the, or let's say that you don't pay any taxes on the cash flow. Then the benefit is that, let's say half your income comes from tax-free cash flow and half your income is from your W-2 job. Well, you effectively cut your tax rate in half. And that's a significant benefit. Cutting your tax rate in half is no joke. The next one is that so the other reason why that's such a huge benefit is that you may actually bump you into a lower tax rate. So the half that you're paying taxes on from your clinical job, then you're actually in a lower tax bracket. So that combined with tax-free cash flow is going to be even lower. And then anybody has this other benefit, which is a 1031 exchange. So what this is that even if you're a passive investor, you can trade your property in for a bigger one. So you can take the gains in that property, put it into a bigger one, and that can be done in a tax-deferred way, just like a 401k, right? You're growing your wealth in a tax-deferred way.
Yeah, I want to go back to the second one, which is any additional losses generated or passive losses, which shelter passive income. So the thing with short-term rentals is, like we talked about a couple of weeks ago, the cash and cash return is generally higher if you're buying it right. Oftentimes your cash flow is so high that you're actually going to exceed a lot of your depreciation losses on your property. But in the case, if you do like a cost segregation study, or you take a bigger chunk of your depreciation up front, you can actually exceed the amount of money that you're making with your short-term rental actually significantly and have all these extra passive losses. And passive losses can shelter passive income. And so if you're a doctor who owns a surgical center, you have a lot of passive income coming in, you might buy a short-term rental and actually take a lot of that depreciation loss up front and choose to shelter other passive income with that. And you can do this even without materially participating, not being super active in your short-term rental. And people do this with long-term rentals as well.
Yeah, and there's actually a cool strategy where you can take your cash flow, right, from your property, and then you can buy a long-term rental and shelter your cash flow from your short-term rental. So there's a lot of ways you can play with it. The other thing I wanted to point out is that these passive losses, even if you don't use them, you can still use them at some point down the line. You're just not using them right now. And that's the time value of money. And that's why active investing is really attractive, because you can shelter taxes now and use those tax savings to reinvest. Whereas in the passive situation, you don't lose those benefits. You just kind of use them later down the line. One time you can use them is when you sell your property. You can take all the accumulated losses and use that to shelter the gain that you get in the property. Anything left over, you can actually still shelter income as well.
But if you have passive income, you can use the passive losses right away.
That's right. If you have passive income, then you can use them right away. All right, let's talk about now if you choose to be an active investor, and this is really a choice. This is something that anybody can choose to do. You may think that, oh, I don't have enough time, but the requirements really aren't that difficult, I think, in my opinion. I think the other cool thing about this is that you can actually share the hours that you need to accumulate with a spouse if you're married, right? So your spouse could do half and you could do half, right? And that's what's really cool about this.
And I just want to point out, we did this in late 2020 with a short-term rental, and I was pregnant, we had 2 kids, we had a company, and we had probably about 85 units of long-term rentals at that point. Plus, I was just finishing working half-time. So you can definitely do this if you want to.
Yeah, and I was in the process of buying another 70 units or so, right? So yeah, so anyway, the idea here is that you have to, in order to be active, you have to materially participate. And what is material participation? Well, there's 7 different tests. You just have to meet one of the 7. The one that most people start with, if they're just getting started, they're getting their first property, is the 100 hours and more than anyone else. So you have to spend 100 hours. Again, it can be split with your spouse. So you could do, if you're the full-time clinician, you could do 20 hours and your spouse could do 80 hours, let's say. But you have to do more than 100 hours. And then you have to do more than anyone else. And so I think the reason why this is called a tax loophole is that you can actually do this towards the end of the year. And let's say that
because it's in the calendar year.
It's in the calendar year. So we bought our property in September. We did a little bit of renovation, got the place ready. And then by December, we launched the property. We put it out there and we rented it 3 times in December, and we handled all that. And it was no problem. I mean, we did all the property management. We leased it up ourselves. We organized the cleaners to come in. We did everything ourselves. And then in January, then we handed it off to a property manager.
So you can see what we did was we did 100 hours more than anyone else in 2020. And then in 2021, we handed it to a property manager, and now it's passive. So that first year, 2020, it was active, and then it became passive. And the second year, because you take bonus depreciation the first year when you're active to shelter active income, the second year, when you hand it off to a property manager, now it's passive, but you're going to make income, and you're going to make so much income, you're going to exceed your depreciation each year. So you're going to be paying taxes on that passive income, unless you go buy something that creates passive losses, like a long-term rental, or you go buy some more short-term rentals. So there are ways to do it for 1 year and then hand it off. And I also want to clarify one more thing, which is this is regarding short-term rentals. And the IRS defines short-term rental as an average length of stay of 7 days or less. And so when we rented ours out in December, we had 3 stays, but each stay was 7 days or less. So we had an average length of stay over the calendar year of 2020 of 7 days or less, so that we could fit into the short-term rental tax loophole. And then we did the 100 hours and more than anyone else.
Okay, so how does this work? So, and we'll show you an example so you can kind of just see it visually, right? And I know we're throwing a lot of terms here at you, and that's why we have the Q&A. So if you have any questions about these things, just put it in the Q&A. There are no dumb questions, so just throw it in the Q&A. So how does this work? So in the first year, so in 2020, when we bought that short-term rental in September, we used something called bonus depreciation to shelter not only the cash flow from that property, but also anything left over we use to shelter W-2 or 1099 income. And it's because we materially participated in that property in 2020, we were able to take those losses and shelter the income. Now, the bonus depreciation, that's something you can do on any property, actually. You can actually do that even on a property if you're passive. It just means that you're going to have these big passive losses, and you better have, you'd want to have a lot of passive gains to offset that, to use it that year. Right. Otherwise, you wouldn't necessarily do the cost. It's called a cost segregation study to get the bonus depreciation.
And a cost segregation study is when an engineer goes to your place and they kind of walk through the whole building and they look at things and they bucket it into different lives. And 100% bonus depreciation means that anything that has a lifetime of less than 20 years basically gets written off in year 1. And so the back of the envelope calculation that we do is with short-term rentals that are a single family home and, kind of closer to a river like ours, where the land is more expensive, we generally back of the envelope about 20% of the purchase price is going to be off in bonus depreciation. With a long-term rental that's got a lot more units and cheaper land, usually it's closer to 30-35% even sometimes, but we're a little bit more conservative when we're doing the back of the envelope with a short-term rental that's a single family home. However, that being said, this one, our one generated about 200,000.
Yeah, so it was a lot. So we got a 660,000 one, and in the end, with the furniture and renovations, it was like a $275,000 loss that we created. And I'll show you a illustration of that in the following slide.
But that being said, we just bought a Dallas short-term rental last year, right? And that one ended up being 1.1 million. And then our bonus depreciation was how much on that one?
250 or so, maybe.
Yeah. So not as good.
A little less than 25%. Yeah. So then in the second year and beyond, a portion of the cash flow is going to be sheltered. So you're going to be cash flowing at that point, and you are going to be paying taxes on anything that is left over after deducting all your expenses. And you do still have those expenses, and you do still have some depreciation. So you're not going to be paying taxes on all the cash flow. And then the last thing is that the 1031, just like in the passive situation, you can do 1031s with with any short-term rental. Short-term rental can be exchanged for a bigger short-term rental or more expensive short-term rental. It can be exchanged for a multifamily. It could be exchanged for medical office. So it just has to be a like kind, which means investment property for investment property is called a like kind exchange. And so you can exchange it for any of these types of properties.
Yeah, and one thing we didn't really talk about is the rehab as well.
Mm-hmm.
A lot of that can be written off as an expense. And so the way I look at it is the government's paying, a third of my rehab costs, and I'm rehabbing it and making it worth a lot more money.
Yeah, and we do cover that in the following slide. All right, so let's talk about how you can cash flow and then show a loss on your tax return. And so this is an example of some of these numbers I just kind of created, but I mean, some of these numbers are short-term rental in the one that we were talking about, we bought in 2020. So on the left here is the cash flow, and the right here is what you report on your tax return. And so on the left here is, let's say you have revenue of 60,000, operating expenses of 10,000, your mortgage is 12,000. So what's left over after all that is cash flow, $38,000. That's actually money that goes directly into your bank account. That's money that you can spend. That's money you can reinvest. Okay. But on your tax return, that's what's on the right. And what you add in addition to those operating expenses and mortgage is that depreciation we were talking about. And that depreciation for us was 275,000.
No, 175.
So, no, 275. Yeah.
Really?
Mm-hmm.
Okay.
Okay. So our tax loss was 237,000. So you can see that it sheltered not only that cash flow, but in addition, there's enough left, an amount left over, and therefore that 237,000 we can use to shelter. Yeah, you remember now?
Okay. I know why, because of the rehab and
Right.
the furniture
That's
added.
right.
So the bonus depreciation was 200,000,
Right.
but what you also wrapped in was the rehab and the furniture.
Oh yeah, sorry, my bad. Yes. Okay, so that's what's wrong. Okay, got it. All right, you're right. So sorry, the depreciation was 200, and then the furniture, and also, but actually the thing is that a lot of that stuff was depreciated, right? We use bonus depreciation for it.
Yes.
Right. Okay. All right. Sorry, guys. All right, so let's talk about possible write-offs. And so the first one is depreciation we just talked about. And then the other two categories we're talking about that accounts for that 275,000 was the furniture and furnishings, and also the repairs and renovations. And repairs are things that can be written off immediately. Renovations, a lot of times those things are depreciated over time, but if you use bonus depreciation, you can write them off immediately.
A lot of them, anything that's under 20 years life.
Yeah. The other thing that you can do is you can shift some of your current personal expenses and have it deducted from the rental property. So you could, so for us, what we did was we took half our cell phone bill, half our home internet bill, and shifted it over to the rental business. And therefore those counted as expenses, and they're expenses that you're already paying for. You just shifted that over to the rental property business. Travel to and from the vacation rental. I don't know if you remember from last week, we talked about, if you spend at least 4 hours working on your property, that would be considered, a work trip, right? So as long as you're spending every day 4 hours that you're there working on the property, then that travel to and from could be considered a business expense. Next would be meals during your work trips to the vacation rental. And then finally, cleaning. So you stay in your short-term rental for, let's say, 4 days. You're working on it for 4 hours a day for those 4 days. And then at the end of it, you obviously want to clean it for the next test. And so cleaning would be also counted here as an expense. All right, so let's talk about what's required for you to get the tax benefit. And so some of these I've already talked about. So the first thing is that you need to own the property. And this came up, I think, a couple of weeks ago. Somebody was asking, if you're doing rental arbitrage, can you claim some of these tax benefits? And let me explain what co-hosting is. Co-hosting is pretty much you're a property manager. So this is, you don't have like a property management company, but you're essentially privately managing somebody else's properties, right, for a fee. And usually you're charging less than what a property manager would pay, would charge. Property management might charge about 30%. Co-hosts may charge 15, 20%, somewhere in there. Rental arbitrage, that's when you lease an apartment and then put your furniture in there and then you rent it again, right? And so this we talked about last week, a little bit risky because the apartment building might not let you do it. I mean, it may be in your lease that you're not allowed to re-rent it again. So this is a little bit risky, but in either case, you don't own the property, right? And so therefore, you're not going to get these tax benefits. You can get tax benefits running a business, right? But you're not going to be able to deduct the depreciation, right, that we were just talking about. You're not going to be able to do that.
Right. But you are, off your cash flow, you're going to be able to deduct the expenses.
Yep, for sure. Yeah, you will be. Yeah, exactly.
Furnishings,
but
things
that's not your cash flow because it's income minus expenses. So you're making income, right, from your all the rental revenue, and then you're going to be deducting all your expenses, including your lease payment when you're doing rental. When we're talking about rental arbitrage. The next one is you do need to materially participate. And as I mentioned, there's 7 different tests, and you have to meet one of the 7. And then most choose that 100 hours and more than anyone if they have just one property. But if you start to get to your second, third property, a lot of people would choose the 500 hours. And the benefit of the 500 hours is you don't have to do more than anyone else. You can actually have a property manager. You can actually have a cleaner that cleans the place, probably several hundred hours during the year, right? And so that test, the 100 hours and more than anyone else, the more than anyone else is the challenge. And therefore, if you get to your second or third property, the 500 hours is often the one people choose. And then finally, material participation. The one great thing about that is that it can be shared with the spouse. And I think that's a huge benefit. Okay. All right, so let's give you an example of us harvesting the short-term rental tax loophole. So single family home in Index, Washington that we bought in September of 2020. And we talked about a lot of these already. So purchase price $660, tax shelter $270. I guess your number is a little different than mine. That included the bonus depreciation, rehab, and the furnishings. We forced depreciation on this property. So we updated the kitchen. We also updated, did a lot of painting and stuff like that. So current value was $900 to $950.
Yeah. And I will say that, we were very mindful to not do the extensive rehab that we really wanted to do, not only because it wouldn't really have had the return on investment, but also we didn't want our contractors to do more time than us because we were doing the 100 hours and more than anyone else. So we had to be thoughtful.
Cash flow per year with a property manager. So this is the second year. We ran at about 38,000 in 2021. And then it would have been greater than 70,000 if we had self-managed it.
Yeah. So this is how you can see just one short-term rental can actually change things pretty significantly for people. And this is why people are so excited about short-term rentals, is not only how much easier the tax benefit is to get versus long-term rentals, but then also the cash flow. And before we end, the other thing we should say that we forgot to do is, we're not CPAs, not accountants, we are not lawyers. So this is not financial advice, and, speak to your specialists because they really know your unique situation. And so this is stuff that we've learned from doing it and from teaching a lot of other people who have done very similar things.
Yeah, right. So Sam said that Kenji gave me the extra 100,000. Exactly. That's awesome. All right, great. Lots of questions. First one, anonymous attendee. Have you ever been audited? No, we are fortunate enough to have never been audited. One thing I love with Tom Wheelwright, he made us repeat. I don't know if you guys know Tom Wheelwright, but he has a great book called Tax-Free Wealth.
Really good.
He said, if you're ever audited, he said, repeat after me. Do not speak to the IRS. So he made us repeat that. So, the bottom line is like, yeah, if it ever does happen, we have really good records and we also have a great team. And so first call would be to our accountant. And then we probably hire a lawyer to defend us as well. So, and they would handle it, right? That's really important.
Yeah, but I will say that, we follow all of the tax rules and we don't let fear of being audited mean that we don't take advantage of tax rules that are loopholes that are there for the taking, because it can really make a big difference in your growth trajectory. And so I wouldn't not take advantage of completely legal tax loopholes because of fear.
Well, I think the other thing is that, it's we, in our courses, we talk a lot about identity. And I think it's really important for you to claim the identity that you're a real estate investor now. And in particular, if you're claiming, let's say, the real estate professional status, or if you're claiming the short-term rental loophole, if you're a short-term rental investor, then you have to claim that identity and say, I'm a short-term rental investor. I materially participate. I'm not trying to get around this law by, doing an extra hour more than the cleaner, right? I'm not trying to do 101 hours and the cleaner does 100 hours, right? What you're doing is you're like literally just going like I roll up my sleeves. This is my investment. I'm gonna maximize the cash flow and I'm gonna maximize the tax benefit. That's why I'm doing it, right? And that's really like that's the hat. If you wear that hat, then you won't have any problems. And I don't think you'll have any problems with an audit either because you've taken it seriously.
Mhm.
Great question, Matt. Let's see. Can you give a general rule about how much tax savings you can expect for someone in the top bracket, for example, with 10% down? How much comes back from a cost seg with depreciation?
Yeah, I think I roughly talked about this, but we do a really rough back of the envelope. However, you can get a free estimate from the cost segregation company. And so during due diligence, we have the property locked up and we're going through and, doing our inspection and all that. We ask the cost segregation company for a free estimate, and we use ETS, and whoever's with us today from our team can put the vendor referral directory there. But they'll give us that number, but our back of the envelope is for short-term rentals. We're more conservative. We estimate like somewhere around 20%, sometimes 15% if your land's really expensive. And that's kind of a conservative number. And then for long-term rentals, we're guesstimating somewhere around 25 to 30% of purchase price. And it's really based on the purchase price. And what they're taking into account is the value of the land, and they're taking into account how many items are in the building that have a lifetime of less than 20 years. And so if you have for the same price, the 32 unit versus a single family home, the 32 unit is going to take a lot more bonus depreciation. There are a lot more items in it that can be depreciated.
Yeah. And yeah, so I guess we did the 25%, right? So if you buy $1 million vacation rental, then you can say 25% or 20%, 200,000. And then if you add on the furniture and
any rehab, and you get most of that
repairs
back right away.
Right. Yeah. So you can kind of estimate how much you're going to be able to shelter with that.
Yeah.
And
no, we've done bonus.
Which question are you answering?
So I'm answering, does the property's purchase price need to be more than 500,000 to do a cost segregation? We've done cost segregations for our properties that are $150,000 single family home long-term rentals, because we've done the free analysis and it's worth it. And so, yeah, we've done that. And $1 in your pocket today as a real estate investor is so valuable, because if you reinvest that into real estate in 5 years, you're going to be in a very different situation. And so our way of approaching it is we try to get every dollar in our pocket today as we can, knowing that we will reinvest it and we will grow our wealth.
Okay. All right. So Sam asks, is a cost segregation study absolutely needed to take advantage of bonus depreciation with short-term rentals? Yeah. I mean, I'm trying to think of an instance where you wouldn't need to.
I mean, I think I think you can roughly guesstimate it, but if you get audited, I would beware. That's all. I think when I think about what our CPAs say about doing a cost segregation study before and a cost segregation study after, we get the cost segregation study before, then we do the rehab. And the question sometimes is, do I need a second cost segregation study after? And, our CPAs feel comfortable looking at all of the repairs that we've done, the itemized lists, and saying, this has this lifetime, this has this lifetime. But I've seen other CPAs are like, I need a second cost segregation study after. I'm not willing to take the risk. And so I think that if you're doing your own taxes, you could guesstimate it, but I think that's pretty risky. And I personally would not do that. I would get a cost segregation study, and there are cheaper ones that are just computerized ones. But we've always done the one where the engineer goes out to your place, because it tends to be less conservative, and it's defendable in that there was somebody at your place looking at it.
Yeah, the computer, there are some where they don't send an engineer, they do a kind of an estimate with a computer or computer algorithm or something like that, and those have not been audit tested. And so there's always this question of like, okay, if you're ever audited, then what happens? Could the IRS invalidate it? getting back to your original comment, I don't know of any accountants that will do the cost segregation study for the before.
No, but I'm talking about people who are doing their own taxes,
yeah.
right? They could potentially do it, and I would not do it personally, but and the company that does the software is KBKG. That we've talked to before, and they have said this is more conservative than you will get with an
conservative
engineer.
Meaning like instead of the 20 to 25%, we're talking 10 to 15%. That's the number they're going to give you. So for $1 million property, they're going to give you a number of 100,000 or 150,000, as opposed to if you send an engineer out, you're going to get a number of 200,000 versus 250,000.
Just an example.
Just as an example, exactly. Alicia, what is a cost segregation study? That's when you send an engineer out to look at the entire property. They like literally walk through the property and they identify all the different components of the property. So they'll look at the appliances, they'll look at the baseboard, they'll look at the flooring, and they'll give each of those components a different life. So the appliance may have a 5-year life, right? The roof will have, let's say, a 27.5-year life. And what Letizia was saying was she was saying that anything less than 20 years can be all written off in 1 year. That's that bonus depreciation. But anyway, even without bonus depreciation, they just bucket all those things into 5, 7, 15, and 27.5 years. Okay. And there is an article that our team can post. It's the title has cost segregation in it. So hopefully they can post that for you and you can take a look at that study.
Yeah. And then
there's that article.
Yeah. And there's another article that we did on the back of the envelope for bonus depreciation, how to calculate it. And that might be another one for people to look at.
Okay. Sam, I've heard of big losses from cost seg study, but can you give examples of amounts in your properties? Also, how do you avoid depreciation recapture at the end if you sell it? I think we answered the first question in the presentation. How do you avoid depreciation recapture? Yeah, so that's a great question. For those who don't know, all this depreciation that you're taking advantage of, you will have to pay back at some point. In other words, you're taxed on the portion so if it's 275,000, you're going to be eventually taxed on 275,000. The way you avoid it is with 1031 exchanges. So what we plan to do is we're going to continue to do 1031 exchanges, and we're going to eventually 1031 exchange into our final property before we die. And then when we die, our kids will inherit that property and they get what's called a step up in basis. If they were to sell it the next year, they don't pay any of that depreciation. They don't pay any capital gains, because they get something called a step up in basis. And that's a great way to pass a significant amount of wealth to your children and never have to pay that depreciation recapture.
Yeah, and I want to answer a couple other depreciation questions that kind of came up that are related to this. So one was, can you only take bonus depreciation the first year? So So that not necessarily. So we do have some people, let's say for the first year you were passive and the second year you were going to be active. There are some CPAs that will let you file a kind of a change. It's called Form 3115, a change in your accounting method. And then you could take bonus depreciation the second year. And the first year you just take what's called straight line depreciation. So you just take 127.5 of the value of the structure. And then the second year you claim the bonus depreciation. However, remember, this is the last year of 100% bonus depreciation, and it's 80% bonus depreciation next year. So I'd say the majority of people were active the first year. We claim 100% bonus depreciation in the first year. And then the next year we go to straight line depreciation, and it's a much smaller amount because we took the first 20 years of depreciation already. And so now we have a smaller amount that we take every single year.
Can we maybe stick to the Q&A? I think it's unfair for the people who are okay. We're gonna stick to the Q&A here. I know there are a lot of questions. These are great questions about bonus depreciation, timing, and things like that. But we're gonna kind of stick to the Q&A. Sam asked, "Does your average CPA know about these short-term rental tax benefits?" No,
not at all.
Not at all. Yeah.
Yeah, so, you want a real estate CPA
for sure. Yeah, and otherwise you're going to be educating them. We've talked to so many people who sat there and tried to educate their accountants, and it doesn't go well.
Yeah, and for those of you who need a real estate specialty accountant, again, the vendor profile has the people that we work with and our students work with.
Okay, Hugh, if you do a cost seg and later do a 1031 exchange, you have to pay back the bonus depreciation. So we were saying that's the way you can defer that depreciation. You can, instead of depreciation recapture, you can defer that to that later date when you sell your last property. But if you never sell and your kids inherit it, then you never have to pay it back.
Yeah, and I will say that some people will make the decision to sell, and they'll have that depreciation recapture that year, but then they also buy another property, and then they use the bonus depreciation from that property to shelter the gains they just got from the property before. And so you could do that too, but the most efficient way to do it is keep 1031 exchanging until you die. And you can 1031 exchange out of a short-term rental into a long-term rental. And so if you have a short-term rental and you went, from a $500,000 one to a $2 million one, and now you're like, I don't want a $4 million short-term rental, you could go right into long-term rentals at that point.
All right, Sam, that's a great question, Sam. If 2022 is the last year of bonus depreciation, you're just starting out, would this change your strategy going forward, or just use the old depreciation schedule after a cost seg study? Yeah, I think for those who don't know, there's something called 100% bonus depreciation. And that's where you can take that 5, 7 year and 15 year, components of your property and claim all those things in 1 year, right? That's 100%. Next year, it's 80%. So you can take those 5, 7, and 15 year components, and you can take 80% of it in the first year. Okay. So it's still a really great benefit. I think it's still going to be a great benefit all the way to 60%. So the following year, 2023 is 80%, 2024 is 60%. I actually think even the next 2 or 3 years, it's going to still be really good. Even without bonus depreciation, when it goes to zero, I think it's in 2027. I still think it's going to be great, because when you bucket into 5, 7, and 15 years, you're still front loading a lot of that depreciation to the first few years. I think what it might change for us is that we might hold on to properties longer.
Mm-hmm.
Right now, we're like really encouraged to
1031.
Yeah, sell 1031 into bigger properties, because, in 2020, what we did was we sold 3 small properties and bought a 32 unit property, and that created an $800,000 loss for us. Right. And so that's a significant amount that we can shelter.
And then we rehabbed it.
Yeah.
So then we got even more losses.
Yeah. So
right?
It was over $1 million easily that we sheltered that year, and anything we didn't use, we can carry forward. And so one of our students, they created a $1.4 million tax shelter. And so that allowed them to shelter several years worth of taxes. And so that was a really huge, and that was just from buying, I think they bought a 60 unit property that year. But anyway, I saw a question in there that, yeah, you can use this for short-term rentals too. You can use the same strategies that we use for long-term rentals, for short-term rentals, by claiming bonus depreciation, by doing a cost seg study and claiming bonus depreciation.
I think real estate is so unique compared to anything else, because even though you're depreciating the structure of your building, it's in the government's eyes, it's losing value every single year. It's probably gaining in value. And so it's just really a phantom loss. It's completely made up loss, which is really remarkable. And I mean, a lot of other property that you're depreciating with any other business is actually losing value. But real estate is not usually.
So Lynn asked, so that's 100 hours per property. Yeah. So you're talking about the material participation hours. Yeah. So it is 100 hours per property. There is the ability to group your properties, but the downside of that is when you group, let's say you have 3 short-term rentals and you group them and you do 100 hours on the group, but the challenge is the more than anyone else, right? So if you have 3 properties, the likelihood that the sum of all the, let's say, cleaning hours is going to be more than 100 hours across those 3 properties. You're going to have to beat the cleaner, right? And you're going to have to do more than the cleaner. And you could probably do that. But at that point, what people tend to do is when they have 2 or 3 or 4 short-term rentals, they group them together and do the 500 hours, right?
Because then they don't have them more than anyone else. Yep. They can have property managers. They can, participate as much or as little as they want.
Okay, Henry, will these tax benefits work if you stay in your short-term rental for more than 20% of the time? Yeah, so that's the thing, is that the rule from our understanding is that it can't be more than 10% of the time or
14 days.
Or 14 days.
Right.
Yeah.
And so
really, and it, if you really want to make money from your property, you want to cash flow and you want to get the tax benefits, then you really got to think about it as an investment.
Yeah, but that being said, you could make it a short-term rental investment for 3, 4, 5 years, and then you can take it over as primary residence, right? Yep. There's no reason you can't do something like that. And so if you're buying a short-term rental in a place you want to retire, have it make you money for a number of years before you take it over.
Yeah. And then the other thing you could do is that you can convert it into a long-term rental, right? And stay in it for a couple months and then
Rent it out
for people for
6
months.
8 days or more,
Yeah,
right?
yeah, 8 days or more on average. Yeah, then it's considered a long-term rental, and it's just different rules. And that's something that we actually chose to do with our Dallas property, was treat it as a long-term rental because we didn't want to fall under the short-term rental rules.
And then we just grouped it with all our other long-term rental properties. And Kenji has real estate professional, and so we could take the same tax benefits and shelter active income because of his real estate professional, because it was an average length of stay of over 8 days that calendar year, and so it was a long-term rental.
Yeah, and then you could stay in your property. You don't fall into the 14 days and 10%, right? You don't fall into those rules.
But I will say that most CPAs will say your intention still has to be to make it an investment property, that it needs to make you money, that you're not just claiming it's an investment property, but really using it only as a vacation home. So ultimately, it's your intention is always really important. And so you can ask your CPA about that, but intention is really important.
Yeah, Joe asks, is it worth it to use a property manager after claiming bonus depreciation the first year? Most short-term rental management charges 20%. Can you still cash flow after that?
So we only buy things that will still cash flow after that, after property management. And that's what our community is buying, things that are, cash and cash return over 20%, ideally with the property manager in place. And you just saw how much money we're making still in the mid $30,000 range, paying 30% for our property manager.
Yeah. And that's why if we self-manage, it really increases significantly to over 70,000 in cash flow that we can make. But Joe, I think the way I would look at this question is really depends on kind of what stage you're in. I think early on, I think
we would have self-managed.
There's no question. Yeah, there's no question we would have self-managed and we would have maximized our cash flow. But even some of the and I think the thing that stops people probably is like the idea that self-management is, it can feel, I can see how it can be intimidating, right? But at the end of the day, it's very manageable and very doable. You just have to believe that you can do it. And once you can, then you can see the type of life-changing cash flow you can make from it. So early on, we would do it. But at the stage we're in right now,
we have 150
units. Yeah.
Over 150 units. It's just, we've chosen not to do it.
Yeah. And for me, the best use of my time, I think, is to go out and look for amazing deals, form relationships with people who are going to bring us deals. That's where the greatest value is. And that's where I want to spend my time. And so, yeah, we're losing some cash flow, but again, frankly, we don't need the cash flow right now. So it's not something that we're not worried about that at this point.
But when we first started, we would have totally.
Yeah, for sure. Yeah,
for sure. Because they would have aligned with our goals.
Yeah. Michael, how long does a cost seg study take to complete? And is there an optimal time to perform one after any renovations? So yeah, normally if you talk to the cost seg studies, they'll say, do one soon after you buy the property. And I didn't always do this, but now I'm doing this more consistently. Like right after we buy a property, I just get I'll get the free estimate actually during the due diligence phase, even before we probably buy the property. And then after we buy the property, then I'll pay for the study. And the cost segregation study usually takes a few weeks, and then the report takes another few weeks after that. So I give yourself a couple months, but remember, you actually don't have to do the cost seg study until right before you file your taxes. So if I bought a property right now we're in March of 2022, and I did a study, I actually have, let's say I didn't do a study, I actually have until next year when we file our taxes. Let's say I file our taxes in October of 2023. Let's say I push off our taxes till then. I have to do a cost seg study by then. So I have a whole year, over a year to do the study.
But I also want to say before and after renovation. So this was a discussion we've had with many cost segregators. And their general advice is do it before the renovations, because there are a lot of things you can write off that you then rehab it and you throw those things away. So you can write them off before you throw them away. And then afterwards, you can get another cost segregation study and take all of the items that you've now added and you now depreciate them. And so and claim bonus depreciation. So you get a lot of that money back right away instead of capitalizing them over, and writing them off over the next 15, 20 years. Our CPA is comfortable enough with taking our itemized deductions from our contractor and saying, this is 5-year half-life. This is a 7-year life, and writing those off and doing it that way because we provide them with such good invoices. But some CPAs will ask that you do 2 full cost segregation studies, and cost segregation studies do cost money as well.
The anonymous attendee had a very similar question. How long does a cost seg study take to schedule and take place? If I buy a short-term rental at the end of the year, do all the work myself, can I get a study before the end of the year? And the answer is you don't have to do it before the end of the year. You just have to do it before you file your taxes. And that's usually April the next year. Eric, we are finishing our primary residence basement and we'll have full kitchen for a partial basement living space or considering a short-term rental. Is there a way to depreciate a new basement construction in a house built in 2003? Yes, actually. So there's something called placed in service. And that means that when you basically start your short-term rental business, when you list the property
for rent.
And so you can actually take a portion of your property, even if you bought it in 2003. We asked this question of our CPA, and we're not CPA, so ask your CPA this question, but you can actually take a portion of the property and depreciate it as if you had just bought it, because you're placing it in service in 2021, right? And so that's something, again, talk to your CPA about. But our understanding is that you can take the portion of the house, right? That's you're using as a business and you're using as a short-term rental and start over the depreciation at that point.
And I'm just going to ask you, because I didn't hear this from our CPAs, even though it's purchased after 2017, can you still get 100% bonus depreciation? Because this one's purchased in 2003.
That's true. Yeah, there's some different rules for if you buy a property before 2017. You're right.
Bonus depreciation.
It could be a different. It could be a different depreciation schedule, and it may be a different bonus depreciation schedule. So you definitely have to check. But our understanding is that you can depreciate. Now, what schedule it's on, that depends on what was going on in 2003. But I think pre-2017, it was the 50% bonus depreciation rule. But check with your CPA. Anchor, is the 500 rule just for short-term rentals? No. So these are material participation rules actually apply to any business. And so like, let's say that it's a dry cleaner, right? And you bought a dry cleaner. So it's the same test, material participation. Do you spend 100 hours and more than anyone else? Do you spend 500 hours? And then that would determine whether that business is passive or active. And these rules are just applied to a short-term rental, which is like a business, right? It is a business. And so that's just one of the material participation tests.
I think what they're probably asking is, does this apply to long-term rentals? And the answer is it does, except for long-term rentals to be able to shelter active income, to be able to shelter your clinical income, you need material participation plus real estate professional. And real estate professional rules are you have to have greater than 50% of your time be in real estate. So you have to work more hours in real estate than you do as a doctor or any other day job. And then you have to have a minimum of 750 hours across your of real estate hours. 500 of which, at least 500 of which have to be across your properties if you're using that 500-hour material participation rule. And so it's not as simple as just doing 500 hours and you're done. There are additional requirements for long-term rentals. And that's why short-term rental tax loophole is so attractive to people, because they can stay full-time and then just do 100 hours and more than anyone else and shelter active income. Whereas if you're doing that with long-term rentals, there's a higher bar to be able to do that.
Heidi, we've been told in the past that contractors and renovation time was not part of the 100 hours that you needed to exceed.
Depends on your CPA. So I would say that we know of at least one CPA at this point who is saying that, not saying that the contractors don't count as the hours, but saying that each individual who works on the property, like you actually spread out the hours that way. There are a lot of CPAs who will say the contractor and their team counts as one team. And so if you have a GC who has 5 other team members, you got to add up all their hours, and if that can exceed your hours. There's at least one CPA we know of who's going to say, well, each individual team member's hours just have to be less than your hours. And so you really need to talk to your CPA on this and kind of see where they stand. But
I think the part that we do know of is that contractors' hours do count, and you do have to do more than 100 hours, more than the contractor, right? And what you're saying is that if there's a contractor and a bunch of subcontractors, it could either be all that whole group added up, or each individual could be separate hours. And so if the general contractor does 50 and these subcontractors each do 20, right, then if you do, you just have to exceed the 50 hours, right? Because that's the one guy that's done the most. But if you add all those up, the 50 plus the 20, 20, 20, then you'd have to beat that whole group. And so, but to answer your question, I think your original question, I think, is that you're asking, do contractors count? Absolutely. Cleaners, contractors, anybody who works on your property, anybody who is affiliated with your property, or you pay to do something, you'd have to do more than.
Yeah. And I think this is a really important point, is to point out that you have to talk to your CPA, because lots of CPAs interpret tax law differently.
Totally differently.
And the difference between saying all the contractors count and you have to add all their hours up versus each contractor is an individual and you only have to beat the contractor who does the most time, very different stance, and can make a big difference. And so this is why you have to have a real estate savvy CPA, and you also have to spend a lot of time understanding their read of the rules to understand what you need to do.
Yeah, and that's a huge thing, because if you have a cleaner that's working, like, they hit their 99th hour and you're just like, okay, I'm just going to hire a different cleaner, because for the rest of the year, because I got to do more than that one cleaner. This is where, again, you don't want to get into these games. You just want to be legit, do more than anyone else, like legitimately, right?
And ideally have excess hours, right? Not just be 100 hours, but be more. So that if anything happens and you get audited and they say these hours don't count, you have excess and you're not worried.
Yeah. Kristen asks, what books would you recommend for someone just getting started in real estate? We actually have an article on this. So if our team could post that article, that'd be a great one to check out, and literally lists the books that we would recommend if you're just getting started. Anonymous Tehendi, how did the depreciation of 275,000 break down? Well, again, that was incorrect. It was 200,000 for the bonus depreciation, another 30,000 roughly for the furniture, another, I don't know,
not even 50, I think,
not
for the
even
rehab.
50 for the rehab. So maybe that doesn't quite add up, but something, those are the rough numbers. Maybe the depreciation number was a little less than 200, but that's roughly how it kind of broke down. So, but we did bucket the three things that we just talked about: depreciation, furniture, and also the renovations that we did. Okay, Simran, what are the good location cities to invest in as a newbie for short-term rental, especially in this high-price market? Yeah, that's a good question. And we covered this actually last week. And there were some links in there to that. I don't know if you have access to the Facebook group, but what do you think?
There's a lot to consider.
Yeah,
it's
so
actually
much
a really
to consider.
in-depth conversation, and it really, we need to talk extensively about risk mitigation too. And you have to see where you kind of lie for risk mitigation, because for us, we have a huge portfolio now. And so we have a lot of risk mitigation built in with all our long-term rentals. And so we can afford to take different risks than maybe you do if you only have one or two properties. And also there's some personal part of risk mitigation too. Like, how comfortable do you feel, buying in a beach town where you're buying a single family home that's not going to have a backup plan of working as a long-term rental? And, how comfortable do you feel if the downturn comes? Versus, buying something that maybe is a duplex in, I don't know, a major urban center that you're using as a short-term rental, but it has a backup plan as a long-term rental. Like, different people will make different choices. And so I think it really is much more in-depth conversation about where your values are, what your goals are, and then what your level of risk is.
Yeah, gosh, there's so many things to consider. And I think that one of the other things we would say is that you can really make a lot of locations work. I'm not going to say any location, because as Letizia was saying, that the risk that you might run into is a short-term rental ban, right? So that's the reason why you really got to dig into the city and understand. But assuming that there's no short-term rental bans, there's no HOA that you're part of where they might ban a short-term rental, then it's really about making your property stand out in that market, and make sure that people choose your property over somebody else's. So I think that you can make it work. I do like avoiding some of these high-priced markets and going somewhere that's a little bit off the beaten track personally, but
And Airbnb does have a list of the most popular,
AirDNA.
or sorry, AirDNA has a list of all the most popular sites, like the bigger places versus medium versus small areas where there are a lot of short-term rentals. You can check that out too. But that's where a lot of people are already buying.
Yeah, and you got to take it with a grain of salt. It's kind of like looking at macro data, and you really kind of need to dig into a certain market, look at where there might be opportunities within that market. But as Letizia was saying, is a big topic. We did cover a lot of some of the key points that to consider when choosing a market. There's a replay right there. You can click on that and watch that. All right, anonymous attendee asks, can you do cost segregation studies after upgrades, rehabs, and done without permits? Yeah, I don't see why not. I don't think those two things are not, they're like in two different worlds. And so the one without permits maybe that'll affect your licensing for getting a short-term rental permit. But I don't think it has anything to do with cost segregation and writing those rehabs off.
Right. But once you've done the rehab, they're going to go in and they're going to look at everything that's present at that point, and they're going to be doing the cost segregation based on that. If you have a lot of information on what you did to rehab it, there's a potential that they might take that into account. But, it's really difficult for them to say, hey, they threw out this much value of property and be able to include that too, because all they can see is what's in front of them. They can't see what it was like before you rehabbed. And so that's why we kind of rehab up front.
I thought they were talking about getting permits for your work.
No, they're saying, can you do a cost segregation study after you've already rehabbed the place without permits? But I think the rehab is important to understand that if you do the cost segregation study before the rehab, that you get to write off a lot of the things that you then throw out. So you get kind of double dipping in a way.
Yeah.
If you do it before you rehab. But once you do it after your rehab, you're not getting to double dip on the stuff that used to be there that you threw out.
Okay.
Because you can't really prove it, right?
Yeah. So the question, I think, we split up the question into two, which is like, one is she was answering the question of like, can you do the cost segregation after rehab? And what a lot of cost segregation companies will recommend is do it before your rehab. And then I was answering the question about what if you don't get a permit?
Yeah, you were answering their question, but I was making another point about it that was really important, I think, for other people to know, is that rehab piece.
Yep. Okay. Onome, as someone who is planning to go into real estate investing, do you advise starting off with short-term rentals? And if so, passive versus active?
So we try to do active whenever we can. In real estate professional is active too, because that's what shelters active income. And sheltering your active income and not paying income taxes for years, it leads to massive growth.
Yeah.
So we're always focused on doing active. Now, the other way you could do it is you could do it passively and create lots of sources of passive income that you then shelter. And I know that, that's probably what we'll end up doing down the road is we'll be passive investors, but we'll have lots of sources of passive income and still reduce our taxes that way.
Onome, I think the way I think about it is that, the tax savings, we don't rely on the tax savings in terms of like, we're not just buying properties just for the tax savings. The tax savings are a bonus. And what it does for us is that, at least the way I think about it, we think about the tax savings a lot of different ways. Sometimes you can look at it as a guaranteed return, like you're going to get that return no matter what. That's great. But the other way to look at it is like a risk mitigation. So in other words, if something goes bad, like let's say that you buy a property, it doesn't go as well as you thought from a cash flow perspective. Well, at least you bought the property and got this like great tax savings from it. And so it's just kind of a risk mitigator. And I think it helps kind of boost that return. But we don't necessarily count on it. But as Letizia was saying, time value of money, if you can get that money now and reinvest it, then you can grow your wealth that much quicker. Also, if you can, if your income is tax sheltered, taxes are your biggest expense, right, in your lifetime. And so if you can eliminate your biggest expense in your lifetime, then your wealth can grow a lot quicker.
Yeah. And there's this really great slide that Tony Robbins shows. He actually looks at if you pay 30% tax on $1 and you basically put $1 a year away for 20 years. And if you don't pay taxes, you end up with like $1 million. And if you pay taxes, you end up with like $30,000. It's a dramatic difference. So taxes really do eat away. And so it really is a great thing to be able to shelter your taxes. But I agree with Kenji, we buy for cash flow first because that's our buffer. And that's also what sets you free, is having cash flow so you don't rely on your clinical income or your day job income anymore. And then the other big one is forced depreciation, which we haven't talked about at all right in this presentation, except that you saw that we bought a property for 660, put in 50K of rehab roughly, and ended up with a 900 to 950 property. So that's forced depreciation. That's adding value, plus some market appreciation in there too, because the market's been going crazy. And then the third piece is tax savings that can make a really big difference in your wealth. And $1 in your pocket today, if you reinvest it, you don't spend it, will make such a difference in your growth.
And the other question I went on my head was about, do you advise starting with the short-term rental? And so it's funny because there's a podcast episode coming out on Sunday specifically talking about this. And so is it okay to give them the punchline on it?
Punchline is both.
Yeah, both. Yeah. So what we say is that, yeah, do both, right? Because,
each has benefits.
Yeah, each has benefits. Yeah, I think investing just in short-term rentals, there's some downsides there, right?
There's a lot more risk.
A lot more risk on the short-term rental side because you're investing in single-family homes.
Usually, unless you're buying duplexes that back up as a long-term rental, and that's not any additional risk. But the risk is that if you're a person buying, like if you're buying like you're on your fifth $1 million short-term rental in a beach town,
they're in beach towns or resort areas, then I would worry a little bit, just because if there's a downturn, they're all simultaneously going to drop in value.
And you might lose a lot of your vacation renters.
Right.
And just be prepared for that, because when there's a downturn, people lose their jobs. They don't have vacation money. And so, we always think about what is the worst case scenario for downside, and then can we mitigate that? And the ways to mitigate it are to have a backup plan, to force appreciation, to take that tax savings. Those are all mitigation strategies. But another mitigation strategy is to have long-term rentals and short-term rentals to spread out your chips among multiple cities. And we've done all that in our portfolio.
So yeah, check out that podcast episode. We do go into it in depth, talk about the pros and cons on each side. And we share our conclusion. Which our
podcast is called Doctors Building Wealth.
Yeah.
So subscribe, and then you'll hear it on Sunday.
Another Sandy, is cash flow then included in your W-2 taxable income? Yeah. So it's not the cash flow, but it's the net income. Cash flow is different than net income because cash flow is without those phantom expenses like your phone bill or the depreciation
or your home office.
But whatever is left over after taking into account home office depreciation and your phone bill, whatever, that you are taxed on that. And so in your second year and third year, you should have net income. You should be making taxable income. And yes, it is going to be added to your taxable income, and you're going to be taxed at the highest rates on that. And that's what we were saying, was that what a lot of people in our community do, and this is why we're saying invest in both, was that in their second year, they make their short-term rental passive. With or without property manager, it doesn't matter. You can still make it passive, but just not tracking the hours and counting the number of hours you materially participate. You can make it passive, and then you buy a long-term rental, which is by definition passive, and you can use the losses from your long-term rental to shelter your passive short-term rental income. So there's ways to deal with that.
And long-term rentals are by definition passive as long as you don't have a real estate professional. And that answers the second question from Hugh, which is, would you do a cost segregation for a long-term rental without reps? This is an example of when you would, because now you have all this passive income coming in from your short-term rental. You're making maybe 70,000 a year or something like that on it, or 50. You don't want to pay taxes on that. Well, buy a long-term rental, do bonus depreciation, and shelter that income. And so now you have more income that's not taxed.
Yeah, it's fun to see some people in our community doing that. Now, some people who started with short-term rentals and now they're going into long-term rentals to create that offset. It's really cool to see. Reem, we have active long-term rentals. I got reps in 2021. Nice. And plan for 2022 also due to a long-term rental going into service this year. If I get bonus depreciation on this property this year, do I need to keep trying for reps going forward 2023 and beyond? How does the tax advantage change as you go from active to passive on a long-term rental?
So this is a really, really great point. Real estate professional and doing the active short-term rental tax loophole, that's a thing you can do yearly, right? And so real estate professional, you can do it 1 year, and then the next year, maybe you go and you work full time and you don't do it. And it's just the year that you meet real estate professionals, the year that you can do bonus depreciation and shelter active income with it. And so it may be that next year, this person's not going to buy any properties. And so why have real estate professional, right? Maybe they can take straight line depreciation on all of the properties they already own. It might be less because they did bonus depreciation the year before. And so they might have a small amount of taxable income, but it's not going to be, probably won't be massive. And maybe they're willing to accept that. Or if they really don't want to pay income taxes at all, then they do reps again. They shelter the other properties gains, and then they shelter their income, their W-2 income as well.
Okay.
So yes, there might be times this is why you need a great CPA too, to strategize. You need to sit down with your CPA and say, if I do this, if I do that, what are the tax ramifications either way? And then you decide if it's worth it. Right.
But what I would say, and what we were taught from one of our professionals is that you really want to have a strong bias and then we go in with a strong bias and validate. What that means is go in with a strategy in mind and then have them validate it or invalidate it. I think it's really the best way to use a professional, just because otherwise, you got to give them some direction and have them react. Work so much better working with a professional that way.
Yeah, and I will say at this point, just because we're kind of drawing to the end, we'll answer several more questions, but I want to make sure that we tell you, for all of you who are interested in short-term rentals and learning more about it, we have a course called Accelerating Wealth. That's the thing you see behind us. And we'll ask them to put a link to our wait list.
Yeah.
Perfect.
Looks like they already did that. Awesome.
Perfect.
Anonymous attendee, should cost segregation be done for long-term rentals?
Yeah, especially, we do it for all of ours because we have real estate professional and we use it to shelter active income. If you have a lot of passive income coming in, that might be another opportunity to do a cost segregation study and shelter that passive income, whether or not it's from passive real estate or it's from even a surgical center or some other place you're making passive income. I know in the beginning when we started out, we didn't do there was no 100% bonus depreciation, but we didn't actually do depreciation. We actually didn't even know about it back then.
Mm-hmm.
But if we had known about it back then.
Yeah, it's kind of crazy that we didn't even know about it. It's like our accountant was supposedly a real estate CPA too.
Well, to be fair, they helped us get real estate professionals. So,
they could have told us. They could have told us about bonus depreciation.
They could have.
Okay, OZ Futures. Do you have to pay back bonus depreciation if you end up selling your property? Yes. So that's
unless you 1031.
Depreciation recapture. In which case, how long do you have to hold a property to maximize that tax savings? So yeah, that question we don't think about because we're going to 1031, right? So.
But I will say that most people within the first, 5 years, you're taking a lot of the depreciation if you're using even accelerated depreciation, right? And so I think a lot of real estate investors will say, hold time 5 to 7 years and then they'll turn it over. But if you're selling, you're going to have depreciation recapture either way. So
yeah, but I think they're asking like if you sell in 5 years.
Are you going to have less depreciation recapture?
No, you're not going to have less depreciation recapture, but you're paying taxes on that depreciation. The question becomes, how much did you really take advantage of that tax savings and reinvest it and make a lot more money to offset the taxes that you paid 5 years later, right? So you got to think about it that way. Again, I've never really thought about that question just because I know I'm going to 1031. And for us, unlike some conversations I've been having recently, what we try to do is we find a replacement property first, especially in this kind of crazy environment. You want to make sure you find your property that you're going to buy first
and get it under contract.
And then go sell your property.
Because 45 days.
45 days. It's really tight in this type of market. You got to really change the way you do it. Okay.
Another good thing to sit down with your CPA. They can do the calculations and they can tell you.
That's right.
This is what a good CPA is for, is running
but
scenarios.
Some of it depends on what you do with that money. right? And what kind of return you get on that money.
And we should mention that the gains, even after depreciation recapture, I mean, it's capital gains taxes. It's less than income tax.
That's true. Yeah.
So.
Does a cost segregation study engineer and CPA care that the work was done without a permit? I don't think so. I've never heard of that. Fatima, with your total losses that you showed, that what percentage of that tax money an individual actually get back?
The total losses means that's how much income you can shelter from taxes. And so let's say your tax rate was 30%, right? And you sheltered 300,000. Well, that would mean you saved 100,000 in taxes.
Yeah. So in April, when you file your taxes, you get $100,000 back. Check. Kristen, prior to buying a short-term rental, how do you come up with an estimate for furniture costs for your cash on cash calculator? Yeah. I mean,
Go ahead.
Go ahead. No, I was just going to say, it's like this is part of your due diligence. Obviously you get better at this over time, right? But the first time you're doing it, you want to get the layout, figure out where you're going to put what furniture, figure out everything you're going to buy, and then you can just go price it out.
The quality that you're going to buy, right? You might buy a different quality furniture for a property that's $250,000 property versus like our $1.1 million short-term rental that we just bought. And that $1.1 million property that we just bought was 4 bedrooms, and we put in sleeping for 10 people. And that cost us $40,000 to have a professional do the whole setup. They did the kitchen, they did everything. And again, we created that to be a long-term rental based on the average length of stay of over 8 days. So we didn't need them more than anyone else. So we just hired them for that. And so our first 4-bedroom was $25,000. So there's can be a real range depending on what you want to do with it.
Yeah. And some people get really creative with, finding deals and really searching on Amazon or other sites. So if you look on like Facebook Marketplace, for example, people are like, not me, but we had some helpers sell $1,000 table for $25. So, I got 10 years, 15 years of life use of it, but they sold it for $25. So there are deals out there. You just got to go look for them. How do you recommend finding the right real estate CPA? Our team can post a link to some CPAs that we recommend.
And I will say real estate CPAs are more expensive. They're specialists. If you have a couple of properties, they're going to pay for themselves, usually with their thinking and their strategizing, but expect to spend, $4,000, $5,000, $6,000, $7,000 and sometimes more, depending on what you choose.
Alrayashi, can you speak to short-term rental arbitrage and how and if it is tax advantaged? Yeah, so short-term rental arbitrage, as we were talking about earlier, is that when you it's also called, it's when you rent a place, you lease it, and then you put it out there as a short-term rental. And so the idea is that, let's say you're renting it for $1,000, and as a short-term rental, you make $4,000, right? So you're making more money. You can afford to pay the lease. And your question about, is it tax advantaged? Well, in that example, yeah, you get your $4,000 of revenue, you're paying $1,000 for leasing costs and all the other expenses like utilities and you don't have property taxes, but utilities and like booking fees and whatever else.
Home office, internet, like
no,
it's a business. You're
maybe.
Right.
You could do those things. Yeah, that's true.
Right.
Yeah, you can do
this.
But what you can't do is you can't do depreciation, right? And that's what puts you in the negative category. And so
as long as you bought it, you bought it right, it should put you in the negative category. But if you bought something that's cash flow neutral, which you might be in the negative category anyway.
But with the short-term rental arbitrage, it's a business, right? And it's not a short-term rental. And so the difference is that with a regular business, if you show a loss, that means you really lost money, right? With a short-term rental, if you show a loss, it doesn't mean that you lost money. You're still cash flowing, right? That's the difference between a business like, so semi-retired MD, our first year, we showed a big loss, but we wouldn't have continued running the business if we continue to show a loss our second, third, fourth year, right? Because that means that we really would have been losing money every year. And that's the beauty of real estate, is that you can cash flow and at the same time show a big loss. With a short-term rental arbitrage business, you want to make sure you're profitable from year one. You don't get that, and you're not going to get that depreciation benefit. So you're going to be paying taxes on your business income, right? So that's how that works. L, you've been running a short-term rental for 3 years. It's awesome. Is it too late to do a cost seg study? No. Also, well, it depends on your CPA. Also, when does it make sense to have one done? Yeah. So this is what Letizia was mentioning before. Write it down. It's Form 3115. And what it is that you're changing the accounting method from what you've been doing probably, which is straight line depreciation, to something called the MACRS, MACRS. Just write these terms down. You can talk to your CPA. If they don't know what you're talking about, then you
Go find
another CPA. So you're changing accounting methods to the MACRS method, and that's what allows you to then claim bonus depreciation. There are some CPAs, I would say a smaller subset than the much smaller minority, who say you can't do that anymore. But prior to Biden coming into office, you were able to do that with a Form 3115.
And again, I would also talk to your CPA about whether or not it's worth it. I mean, if you're actively participating, it sounds like you're running it, then you're probably meeting that 100 hours and more than anyone else, or you have several short-term rentals and you're grouping them together and doing 500 hours. But you want to make sure that it's worth doing the cost segregation study, and you're going to be able to shelter active income. And you want to make sure that you're tracking your hours too. That's one thing we haven't mentioned, but we track all of our hours, material participation hours, in case we ever get audited. We have all the records of all the hours and what we did for those activities. Maybe like 2 more.
Yeah, you want me to do a little bit more? Okay. So Poonam, for how long do you keep a property on average before doing a 1031 exchange? So some CPAs we've talked to say, you want to hold on to it for a minimum of a year, but if you read Amanda Hahn's book on advanced tax strategies, there is a chapter on it where she talks about intent, and she says if your intent was to hold on to it for more than a year, but something happens and you're not, situation changes, life happens, and you no longer can hold on to, you need to get rid of the property, then in that situation, she said in her book that you could do a 1031 exchange if you hold it for less than a year.
But I would say on average, we're keeping properties for 3-4 years right now, because bonus depreciation makes it so attractive to turn things over. We see ourselves as buy and hold investors. We see ourselves holding properties for 10-15 years. It's just right now we're motivated to turn them over. And so I think if you ask me that question, 5 years from now, it's probably going to be a different answer. We sell properties when we need the cash to buy the next property. And we sell properties if they're underperforming, or if we don't believe in the neighborhood, or it's appreciated so much with market appreciation. We don't believe that that's going to sustain long-term, and we just want some extra money to put in another property. So there are a lot of reasons we sell.
Jessica asks, can you offset K1 income or just W2 or 1099? Yeah, you can offset K1 income as well. Kim asks, how long do you have to purchase another property with a 1031 exchange once you sell a property? You have 45 days to identify a property, and you literally list out 3 properties on a piece of paper, and then sign it, and then hand it to your 1031 exchange. They'll send you a DocuSign, and you put in the 3 addresses. And you have to do that within 45 days of selling your property.
And this is a delayed exchange that you're describing. There
is
a different type of exchange as well. We actually have a blog post on 1031 exchanges that hopefully can put in here that will kind of go into a little bit more detail.
Yeah, 45 days to identify those 3 properties. And then you have 6 months since you sold the property, 6 months to purchase the property. And how does it work? You sell your property. You first engage a 1031 exchange property before you sell your property. Then they take the money. You don't put that money in your account. They take the money and hold it in their trust account. And then when you find another property, then they'll transfer that money to purchase the next property. And that's the 1031 exchange company. So the key is you got to work with a reputable 1031 exchange company. Please don't just use somebody that
is off the street.
Is off the street.
Giving your money
to. Because that money could be gone. So you want to make sure you use a reputable company. It's so important. And beware of wire fraud. This has nothing to do with this new investor series, but just in general, beware of wire fraud. Make sure you know who you're wiring your money to, because it really does happen. People take your money. Okay, let's just do.
Yeah, these last two are really
Okay.
easy.
Okay. Can you do bonus depreciation even if you are house hacking in an owner-occupied multifamily using a residential loan with 20% down?
Yeah, so some CPAs will let you separate out. So like if it's a duplex, for example, they'll let you separate out the units and do bonus depreciation on one of the units. But again, you need to make sure it's worth it. And you need to talk to your CPA to see if they see it that way. But I would say like even multifamilies, in our mixed use property, we separated out the pieces, right? So.
Okay. And then another one from Anonymous. Can you group LTR and short-term rentals, material participation and activities together to count towards reps? Yeah.
So not usually. Depends on your CPA though too. So some CPAs will say, okay, let's say you have a group of long-term rentals and a group of short-term rentals, and you're doing the 500 hours and more. 500 hours with your short-term rentals, and you have 500 hours with your long-term rentals, but you don't quite get to the reps 750 or more. Some CPAs will let you take 250 hours from this bucket and put it in this bucket and say, okay, I meet real estate professional for my long-term rentals and I have material participation for my short-term rentals. Now I have both. But some CPAs say you can't double dip on the hours. So depends on your CPA again.
All right.
Okay.
Tim, would you share who your CPA is? Check out check out definitely the link for the CPAs. Our CPA is
incredibly expensive.
Yeah, incredibly expensive. You don't want to use them probably, but it's
but part of what we use them for is semi-retired, right? If we were just doing real estate only, I would not use them.
Yeah, we would use somebody on the list, and we have actually worked with a number of people on the list, right? So in different capacities, but we've worked with them. So, all right, well,
Okay.
good. So I'll copy these questions and then I can answer them underneath the video. So I know that I did see somebody who said it was not in the Facebook group. I don't know if it's possible to just kind of create a dummy account just for this purpose, but I think there's a lot of valuable information in our group. And if you want to watch the videos, it's there. We don't have them anywhere else really, right? So
yeah, and so
actually that's not true. We do send this out.
We send them out in the newsletter
that's right.
every week.
That's
so
right.
if you're on our mailing list,
Yes.
you'll get this one on Sunday, but last 2 Sundays we've been sending it out as well. And our Facebook group is semi-retired physicians or semi-retired professionals. And in semi-retired physicians, physician spouses are welcome as well.
Yeah.
Okay. Thank you guys for joining us. And we have one more of these next week.
Yep.
So we will see you next week.
And what was the topic? It was
long-term rentals versus short-term rentals.
Oh, yeah,
but I'm sure there's a better title than that.
Okay, got it. Okay, sounds good.
All right. Okay, thank you, everybody.
Thank you.
Have a nice